maybe we'll take everyone back to when they're 15 or 16 or 17 and you don't have a
Ooh,
car, right?
ooh, yeah.
When you don't have a car, what are you dreaming of, Douglas? You're dreaming of any car.
Dreaming
Because
about the
you
bus.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Getting after it.
Yeah, Douglas, there's some bookkeeping we got to take care of right off the top.
Okay.
There's three things. First is I feel like before cell phones, a wrong number happened more frequently because everyone had to dial that thing. So I remember as a kid, like, it seemed like you pick up the phone and 10% of the time, it's like, sorry, wrong number. I have
Okay.
a feeling that Douglas over there had like some fancy spiel when someone called his house with the wrong number.
There's no such thing as wrong numbers.
You just start chatting.
Yeah. Now we struck up a new friendship.
This leads me to last night. It's about 10 o'clock. Sometimes when I take notes for the show, I send myself a text message, right? And somehow I had selected a number that was one digit off of my cell phone. So, like, basically, some people call that cell phone neighbors. Have you ever heard that?
No, because you just made it up. Continue.
This is what I texted some random person last night. Morgan Housel dopamine. One text. Next text, bubble. Next text, meta craziness. And at midnight, this poor soul texted me back, what? Is that terrible? Turns out a few months ago, I had sent him some data on housing market starts and some other boring investing podcast tips.
That's amazing. Can you keep this going?
I've tried to decide. I might use your methodology and just turn this into a friend.
Yeah, I think you should save the number as some, I don't know, Jimmy, whatever it might be, and just like start up a beautiful friendship. They can start coming over for Thanksgiving.
Okay, that's point number one of housekeeping. Point number two is a quiz, but we're going to get to that after we hear about the Skippy and Dougles correspondent that we sent out to North Carolina this week to see the Duke Blue Devils take on the lowly Wake Forest Demon Deacons. Could we get an in-game report, Douglas?
Yeah, I mean, first of all, they crushed. The Blue Devils crushed
a 1 point
Demon
win
Deacons.
At home, right? Is that the
yeah? It's binary at the end, so it's all just a crush. So there's this dude on Wake Forest by the name of Appleby, last name Appleby. He's a little guy in basketball standards, probably has me by about 50% height, but little guy by basketball standards. And he was just doing whatever he wanted to do up on there in the court. And at the end of the game, 0.5 seconds left, for no particular reason, fires up this long distance three, swish. And I was like, man, if we hadn't made those free throws that also seemed like they didn't really necessarily matter, like a few seconds before, whew, game ave, as the French would say.
Yeah, we should sign Appleby to NIL deal for the podcast. Probably. I'm going to reach out. Yeah. All right. The last order of opening business is a quiz for you. So there is an activist investor named Nelson Peltz that's all up in Disney's business. Yep. Yeah, okay. All up in Disney's business. One of the things he's concerned about currently is executive compensation. And to give an example of why he thinks executive compensation at Disney is out of control, he talks about Bob Iger's compensation since 2007. You want to venture to put a number on that?
This is total compensation?
Total compensation of Robert Iger, the CEO of Disney, since 2007.
All right, so let's just say about 15 years. I know there are a couple of years that he wasn't there, but I'm just going to round it. 15 years. I'm going to go ahead and say $2 billion.
Okay. It's only 1.1 billion.
Okay.
Only. I think that's an insanely high number. Now, maybe I'm crazy, but to me, that's pretty obvious that maybe executive compensation isn't in line with reality. Since from 2017 to 2021, he got 473 million of that. So to call it $500 million in 4 years, it's craziness. Am I the only one?
No, you're probably not the only one. I'm doing a quick Checkity doodah. So if I just do this rough eyeballing, Disney's stock has gone up by about, and this is not all CEO, of course, but has gone up by about 3 to 4x over the period of time. Its market cap is at about $200 billion. So that means, let's just say it went from 60 to 200, roughly, like just to eyeball it. So there's $140 billion in value creation that has happened for the organization during that period. This is all like high level, right? But there are multiple ways to look at compensation, is all that I'm saying. If you look at an absolute dollar figure, that's one. And I'm not saying that it's not ridiculous, but I'm saying if you look at an absolute dollar figure, that's one thing. If I told you the CEO of a large organization received 0.7% of the value that they created over a 14-year period, what would you say?
Okay. I can't even answer that question. I got to go with Doogles put on his management consulting hat and just talked value creation and threw out some garbage to say, oh, one individual on earth clearly needs $1 billion. I'm as much of a free market capitalist as anyone, but oh my goodness, like we're talking about figures that are so much money that people can't even spend it. And this goes to something I want to let you jump into your fishbowl, but I want to talk about Morgan Housel's piece this week where he talks about spending. And for certain people, it becomes only about they spend things only to have something they can't have, almost regardless of price. This is a topic that I continue to be fascinated with. This is part of the reason why I'm fascinated with the David Marks Status and Culture book, because like there are these people out there, and I'm not immune to it, that just there's never enough money. And when I see someone get a paycheck of $1 billion, congrats to Bob Iger. Like this isn't really about him, but what wants and needs could he not fulfill if that paycheck was 100 million or even $20 million? I'm not sure what they are.
Materially, not much.
Yeah,
not much. But I think it ends up, so look, I'm actually, just as you know me for a couple decades now.
Yeah.
I just come after it, like without any need to have a view. I'll just come after an argument. So
I love it.
I think one thing that's also interesting here, if you ignore the fact that a CEO, let's abstract it outside of Disney for a moment.
Please.
If you ignore the fact that a CEO was hired in and then given a compensation, and instead let's go to like a Bezos, and you say that the CEO started the organization.
Oh, that's a different ballgame.
But the abstract point that I want to make, I'm not disagreeing with what you just stated, but the abstract point I want to make is there a cap on the maximum amount of value that was created for an organization that the CEO should get?
No, not at all. And in the Zuckerberg or Bezos, or there's countless other founders that have built the company to zero to one of the world's largest and most impressive enterprises, and they own a lot of those shares. I mean, even a lot of the companies that Musk has had a part in and like built from scratch. I have no issue. Again, I don't really have an issue with Bob Iger's compensation. Yeah. But it's different when it's your company, you build it from scratch, than it just is to show up somewhere, say value creation a bunch of times, ride a 13-year bull run and be like, oh, there's $1 billion. My point is more just like, what do you do with $1 billion? Like, how does that make anyone's life better?
Okay, we're going to get to your actual point in a moment, because I do like Morgan's piece. But let me give you one more. Because we need to define from scratch with what I'm about to throw out. We need to define from scratch.
Musk didn't build Tesla from scratch. He just came in, bought some shares.
I'm gonna go even further back. I'm gonna go further back, decades, my friend. I'm gonna go back decades to a textile business.
I have no problem with Buffett, man. You're gonna talk Berkshire Hathaway. Buffett goes in, buys significant pieces of businesses. Sometimes he buys the entire business, and he sees the fruits of that labor. Like, he is deploying capital and he's seeing excellent return on those investments. You and I are investors. This is an investing podcast. Like, by all means. Again, it's not the absolute dollar figure that really. I'm not even fired up. I don't know the right term here. I'm just kind of like $1 billion. It's a talking point.
It's a lot of dollars. It's a lot of
Yeah.
dollars. Okay.
I mean, so Buffett is worth how many billions and probably makes $1 billion in dividends. I don't know those numbers off the top of my head, but like Apple just played a 23-cent dividend, and I think he has like 100 million shares or something. Like he makes plenty of money on a yearly basis. I totally get it and applaud Buffett for that.
Is a question here from you then. There's one that you threw out of like, how much money do you really need? And therefore, how much does someone really need to get paid? There's maybe a secondary one of what happens to that money if it doesn't go to the CEO? Would the shareholders of your organization love to have another $500,000 that is distributed out? I don't know.
That's where, yes, the argument typically goes, oh, well, this CEO has a unique set of skills. Look at the value creation, and the market's really competitive. We want him to create value for us rather than someone else. So that's the market rate. That's what we need to pay. Makes sense. Free market economics. Again, totally on board. But yeah, I think that could be reinvested in content for Disney. It could be reinvested in their parks. It could change your average employee compensation package significantly. If you just had a billion extra dollars, say you only got paid 100 million, if you just had $1 billion extra in the comp pool, like what could you do with your senior execs or maybe like your so-called average employees? I would venture that there's better places for that money to be spent. But hey, Disney's created $160 billion worth of value, so they're clearly doing something right. Like again, I'm not really calling anyone out. I'm just
agreed. Yeah, it's interesting, and it also the question going back to even your point around like unique set of skills, et cetera, et cetera. What is the amount that individual would need to get paid? What's even ignoring the absolute dollar figure? What is the excess compensation that they are receiving over what they would need to receive in order to keep the job and do the job at that level is also like an interesting question.
So let's talk Morgan's piece, because I think this is truly, I didn't even mean to talk about $1 billion. Like this is truly what I'm so fascinated with. So Morgan talks about dopamine in the brain and this competitive nature of almost spending money. I see this all over the place, and we talk about this on the show a bunch. But one of the first things he says is, and think back, maybe we'll take everyone back to when they're 15 or 16 or 17 and you don't have a car, right?
Oh, yeah.
When you don't have a car, what are you dreaming of, Doogles? You're dreaming of any car.
Dreaming about the bus.
No one's dreaming about the bus. Right? You get literally any car. My first car, one window didn't roll down. If you drove for more than like 50 minutes at a time, stopped to get gas and tried to start the thing again, you'd have to let the engine cool down for about 5 minutes before that thing would fire back up. Like literally any car, right?
I had a car. This wasn't my first, I think it was my second. But when I got out of the car, I'd have to unhook the battery because when the car just sat, the battery would drain. So when I'd give somebody a ride, I'd be like, hold on, I got to pop the hood right quick. And then I have to put the battery back on there. There was my first car was gifted to me by like just another family in town. And the guy was like, this is the second fastest car in town. I just want you to know what you're getting. I was like, oh, I was like, what's the first? He goes, I don't know, but not this one. So anyway, continue.
So any car, you and I have some good examples of any car, right? Then you have your car. Maybe it's a $2,000 car. Maybe it's a $5,000 car. You drive that thing. You get used to that lifestyle. A buddy of mine says, luxury once tasted becomes a necessity, right? So basically, that $5,000 car, man, that's like, I like this. And look at that $10,000 car over there. You save up, maybe you take out a loan, you get that $10,000 car. Once you get that, you're dreaming of the $20,000 car, $20,000 to the $50,000 car, $50,000 to the $100,000 car. Like this is in Morgan's piece. It's a great example. You're always trying to get that next dopamine hit to say, oh, now you and I both drive very reliable fine cars. But I told you 3 weeks back, I was looking at electric SUVs like, oh, that'd be cool. But it actually wouldn't. But that's the trick our brain is playing on us.
It's a very Buddhist philosophical like angle that this is taking.
Talk to me about that.
Just the principle that people always, it's the same principle. The people always want more, right? And there's like just being satisfied with like where you are, dispelling material like needs, because otherwise there's like a statement, I can't remember what it is, but it's a statement that's kind of like that involves water, like the fact that water will fill whatever the size of like the bucket is, and that's kind of how human wants are. And so I wish I should have, having the fact that I just brought up Buddhism, I should have had more to back that up, but it made me go back to my Buddhist readings.
No, all good. But I was fascinated by this this week, and have been fascinated by it. And where my head explodes is when I see something like that Bob Iger figure, and I go, did Bob, as a 20-year-old kid, ever go like, the right paycheck for me over a 15-year period, it's probably $1.1 billion. I can't imagine he did that. Now, maybe he did, but at that point, sorry, it's still not about Bob Iger. At that point, the person collecting $1 billion paycheck, the only thing I can imagine that's going on in their head is a competition with other really, really wealthy CEOs to see who's making more money, because I don't know how you spend that much.
It's a lot of money. Do you know when, again, ignoring the Bob Iger piece, but when figures like that are quoted, do you know if that's the figure that they were compensated at the time? Or if it's like, for example, in 2007, if Bob Iger got, I'm not going to do the math here, right? But like $1 million in,
and then in stock, and then it grew.
Yeah. Like, I don't know what, it obviously would have had to be more than that, but.
So this is straight from the Wall Street Journal. It says realized 1.1 billion in total compensation. So I think there is some equity growth in there. And this was a analysis of proxy materials completed by Equilar, equity compensation data firm. I mean, so yeah, and again, sorry, I wish I almost wanted to said his name. Like, it's not about him. Yeah. It's just about that kind of dopamine piece and how we battle that in our brain. Because for everyone, your current paycheck plus 20% sounds awesome. And a lot of people are blessed to get that year after year or decade after decade. And you know what still sounds good to them at this time? Their current paycheck plus 20%.
Yeah, exactly. It's just an equation, no matter what you put in the first cell, right? Yeah, I love that. I'm going to use that as a transition point, as a fishbowl transition point, if that's cool. Does that work?
Yeah.
There was this Substack that came out in the past couple weeks that laid out a 2010 investment letter from Seth Klarman. Seth Klarman runs a Baupost fund. He's a value investor of lore. And the reason that 2010 is interesting here is because and let me pop this open so I can give credit where credit's due for the author. Connor McNeil put together this Substack. It's on Investment Talk, and it's called The Forgotten Lessons of 2008, Seth Klarman. So why 2010 is important here? Because 2010 came a couple years after the great financial crisis in 2008. And basically what it's saying is Seth Klarman was like, 2 years ago, the world was coming to an end. Investors were getting punched in the face on the regs, right? And now I'm looking out in the market and it looks like you're acting like that never happened. And so Seth Klarman wrote this piece that it was 20 investment lessons. I will not lay them all out for you all here, but I'm going to start with, I picked out 5, and I'm going to start with one that just reminded me of what you were just talking about a little bit. So one of the ones he says is, nowhere does it say that investors should strive to make every last dollar of potential profit. Consideration of risk must never take a backseat to return. To look at the first half of that around every last dollar of profit, when I think about what you were just discussing on the dopamine hit, is you could have most people probably don't have sell criteria, right? Like when you're going to sell your investment. But even if you do, and you get to that, and if you see this upward trajectory, then you're like, this plus 20% sounds better than this price.
Of course it does. Yeah.
Yeah. Of course it always does. And from a discipline perspective, I think that it is important for nowhere does it say that investors should strive to make every last dollar a potential profit, right? You should be disciplined. Now, at the same time, you can sell too early. Like, I know that that's a thing. And usually, like, there's statements that say that people typically sell winners too early and typically hold on to losers too long, right? Like, that's like a thing that's thrown out there. I don't know if there's science behind it or whatever, but that's something that's thrown out there. So it's a balance. But you just reminded me of that one point from Seth Klarman. I have 4 others. I don't know if you have a comment on that one before I hit on a couple others.
No, I want to hear the others.
Cool. Another one is things that have never happened before are bound to occur with some regularity. Love that.
Yeah, this to me is what I was saying with the Misbehaving Markets book. It's the fat tails piece. Like, the 24 sigma events actually happens in financial markets because of how complex it is.
Yep. All right, here's another one. You must buy on the way down. There's far more volume on the way down than on the way back up, and far less competition among buyers. It is almost always better to be too early than too late, but you must be prepared for price markdowns on what you buy.
Thank you, Mr. Klarman. I struggle with this. It feels terrible every time to buy Meta at 160 and then buy Meta at 120 and then buy Meta at 95. It totally sucks. So I just appreciate the reassurance from Legend.
And there's so much that sits behind this one. I'm going to pull out a couple phrases and also explain them. So there's far more volume on the way down than on the way back up. What that's saying is, and the volume he's talking about is like if you are buying a stock, let's say, that means someone is selling you that stock. Mm-hmm. And when things are going down, there are more sellers because people be scared, right? People be scared. I kind of want to bring up the Diamond Hands, Paper Hands, Bruce Lee GIF that I sent over to you. We'll just put that in the Substack though. But when people are panicking, let's just say, I'll just use panicking just to go to the extreme. If people are panicking and selling, that's where there's a lot of volume. There's a lot of ability for you to buy because everyone's trying to sell. When it hits the bottom is typically at a point where it's the absolute pessimism, right? And so therefore people are real scared, right? And so at that point, if you're trying to buy, then there's less volume, right? Is like basically what he's saying. And so at that point, you also have less competition, right? Which goes along with the volume point. And then the better to be early than too late. For me, this point, it corresponds largely with investment horizon. Because if you have a short investment horizon, like if you're trying to day trade, let's go to the extreme. If you're trying to day trade, then you can't be too early or too late. Like you kind of have to hit that on the head.
Which is why day traders always lose money, because you can't do it.
There you go. But if you're saying I'm going to buy this for years, whatever that period of years is, then most likely, like being a little too early, you can't be. I'm not talking like, the market's going to crash and you start shorting the market in 2012, right? When the market doesn't go down until 2020. But being like a little too early is better. And from what Seth is saying here. All right. Last one. Beware leverage in all forms. And then there's a bunch of stuff that he writes. And we're going to put this out, and when you read it, I'm skipping a few sentences that he has in this point, but going to the last point. So beware leverage in all its forms. Even if you are unleveraged, the leverage employed by others can drive dramatic price and valuation swings. Sudden unavailability of leverage in the economy may trigger an economic downturn. This really hits home for me because I just finished reading a book, very, very nerdy, right? Very, very nerdy. Most of the books I read are nerdy anyway. This one is called More Money Than God. Have you read that?
No.
It goes back through histories of hedge funds. I think it's interesting for those that want to read about the history of hedge funds, and in particular, like certain moments in time. Like it cataloged like when Soros and Druckenmiller shorted the pound, right? Like it went like kind of like the minute by minute, hour by hour of what they were thinking and what they did. And so if you're into that, it's interesting. 99.999% of the population is not only uninterested in that, but have already shut off this particular recording. But anyway, I just read More Money Than God. And the reason that this makes me think about that one is because it highlights so much of the leverage that could sit in the system, which is what he's saying here, that even if I'm not borrowing money, if I'm investing in things that are highly levered, then you end up in a place, and if they're highly levered and they might be investing in things that are also highly levered, right, and derivatives and all this other stuff, then effectively that's leverage in a form. And he's saying beware of leverage in any form. So and it's not avoid leverage in any form, it's saying beware. Just to be clear, there's a difference there.
Yeah, definitely. Really good point. It's something you have to think about, even if it's not on your balance sheet. I liked point 12 as well. Make sure that you're well compensated for illiquidity, because you can find a deal, right? And if I find a stock that I think is trading at 50% off, that's one of the largest companies in the world, versus a small illiquid like OTC stock, well, I need more of a discount to deal with that potential illiquidity, because it means I can't get in or out nearly as quickly as I want to, which changes your time horizon, which changes everything. So I thought that was a good one.
Yeah, that's a good one too.
All right, you just talked about books. The next thing on my list is, I think you made it through The Wealthy Barber this week.
I did finally. You've been talking to me about The Wealthy Barber since we were in diapers.
I want to talk to you about, so I think the hokiness of it maybe got in the way of some of the principles, which I understand, but I want to talk to you specifically about that point, because we texted about this. I mean, I think it is pretty hokey that he's a barber in the northern US. Where are they? Michigan or somewhere? And like the story that's concocted to try and teach some of these basic personal finance things, I always thought was just a little hokey, but not the main reason I was there, so I pushed it to the side, and I'm curious how that worked out for you.
So I'll say this, I enjoyed the book for the reasons that you recommended. So it's much simpler than other books that are like this. Like, and by simpler, I mean, it breaks it down to like relatable and understandable, everyday type of stuff. It covers a broad range of financial areas in like a storytelling way. Thought it was good. Talked to my wife about it. We like bought another copy of it. Like it's like a part of our.
Oh wow!
Our home,
see,
right?
I thought
it's
you
good.
were much more lukewarm on it than that.
No. For the book's perspective, I think it works. Where the lukewarm came from, because this is what you're talking about, is I was like, we discuss all the time, and passion of mine is how do we get these principles to the people that are generally speaking not going to be like learning this kind of stuff. And I pictured, if you look at the cover of the book, the cover of the book is off-putting for certain populations.
Yeah,
right?
It's hokey. It's I think it was first written in the 80s. Like some of it's definitely outdated in terms of fees on investments and other things. But yes, I think that's a very fair, not even a criticism, but like I hear you.
Yeah. Because I always think, and this might be oversimplified, but I believe that a lot of times when it comes to quote unquote complex and unapproachable topics, such as like money, finance, and investing, which I do not believe that they have to be complex or unapproachable, but that's like how they're viewed and sometimes positioned in society. When it comes to things like that, individuals will look for any reason why that does not apply to them.
It's a great perspective.
I think, right?
Yeah.
And here I'm like, there's so many. Like I look at the cover, that don't apply to me. I'm like, Port Huron, that don't apply to me. Who the heck is this barber? That might apply to me. A barber might apply to me. That barber don't apply to me. Right? There's like so many like aspects of that. And so that's where I just started thinking, like, how do you get this into like the hands of the people that be like could see themselves in it?
Yeah, I mean, it's like, if I remember correctly, heavy on golf, and I think they have vacation homes, and it's like very targeted to this type of person.
Yeah.
That's good feedback. I appreciate it.
But it's cool. It has like a chapter on different like types of financial instruments, I'll say, because it's like life insurance and like it just hits on so many areas that it's cool. Like, thank you for it's kind of, it feels disingenuous for me to say thank you for recommending it, because you have brought it up so many times and it took like decades for me to pick it up. But still, thank you. Finally got to it.
That's awesome. Well, so one of the next things for me is I want to talk about your favorite subject, the U.S. consumer. But if that's not on your list, I'll kick it to your fishbowl first.
I assumed we were going to talk about it, so I didn't put it on my particular fishbowl list, but I'm excited to get to it. Let's see, which one of these things? I'm going to stick with investment letters for a moment and hit on a couple points from Greenlight Capital's recent investment letter. David Einhorn, Greenlight Capital, value investment shop. I loved a couple points from here. So one is, this starts off by saying, we made 37% in 2022.
Which 37%. Is massive.
Yeah,
I don't know anyone else off the top of my head. I haven't gone through all the hedge funds and stuff and like value investing shops, but that in 2022, when everything's down 17 to 20%, is tip of the hat, man.
Yeah. And what I loved most about that, aside from the fact, like, good for you. And through this, they talk about how it's been tough, because it's been tough for value investors during this last, not all value investors, I just mean like the value stocks, I should say, maybe in general, during this last bull run. And one of the things they say here, so talked about that and then said, we are probably not as smart as we appeared in 2022, but we are probably not as dumb as we appeared in 2018 either. The market environment, as we have been highlighting, turned extremely favorable for our strategy in a period that immediately followed one that was extremely unfavorable for our strategy. I just love like this. They just lay it out there. And I really like that.
Well, no, there's so much to love about this letter. One is at the end, he's like giving shout outs to a person on his team that got married and a couple that had a kid. It's a great letter.
Real talk. One other section that I found particularly interesting is, so they lay out what the portfolio was comprised of. And it was a mix of like long holdings, like so buying stocks and looking for them to appreciate. There were some shorts. There was a bunch of stuff in there. And there was a section on shorting bubbles that I found interesting to read. So what they started doing about a decade ago was creating this bubble basket of stocks that they would short in this bubble basket. And they went through a few iterations of the bubble basket. Generally didn't work out all that well for them because of the bull run that happened over the last decade. But there are a couple points I found interesting. So one is, we define a bubble stock as one that, if we look at the company's current and projected financials, counting stock compensation as an actual expense, I love that they pulled that out as just like a little jab, and perform a traditional valuation analysis, it could fall at least 80% and still not appear cheap to us. That is their definition of a bubble stock, is if we do a valuation on this and it drops 80%, it still would not be cheap. And that is what they define as a bubble. If you think about the reverse idea of a margin of safety, like that's kind of an interesting look on it. So then it goes through this whole thing where they have like bought stocks, and some of them like quadrupled after this. So like it didn't quite work out. Some of them ended up growing into their valuation. But they started this in 2013 and said in 2013, it was a year of enormous gains for a number of speculative stocks. In early 2014, the bubble appeared to be breaking, and we created our first bubble basket. This proved to be very premature.
like 7 years.
Yeah, exactly. I absolutely loved it. Then one other point here. I'm gonna make a big assumption on who they're talking about here, but I don't think it's that big of an assumption. This is talking about the bubble stocks again. In early 2021, we also identified an actively managed ETF of so-called innovation stocks that appear to us to have significantly similar characteristics to our bubble names. We shorted a basket comprised of the components of that ETF in February 2021 that we ramped up to 9% of capital. it has declined 76% from our first entry. We don't even need to name it.
Oh, that's so funny. Oh my goodness. Shout out to Greenlight Capital. All right, here's the other thing I just have to mention. So he's kind of talking about 2022, but he's also talking about the current environment, quitting Field of Dreams. And so Shoeless Joe Jackson goes to Archie Graham, right? He goes, the first two were high and tight. So where do you think the next one's going to be? And Archie's like, well, either low and away or in your ear. Shoeless Joe goes, well, he's not going to want to load the bases. So look for low and away. Archie Graham's like, right. He's the young kid. This is his first professional at bat. And as he's walking away, Shoeless Joe goes, but watch out for in your ear. This is the market right now, man. Yes. There's like some deals out there. It's been like bubbly, and you think that a strike has to come your way, but man, it still might come in your ear.
Yeah, exactly. That is exactly right. I love it. All right. You want to dive into consumer stuff? Is that your next in your fishbowl?
Yeah. So I really pulled this article just for you. The Wall Street Journal has an article, another great headline. The U.S. consumer is starting to freak out, just like facts and charts about the U.S. consumer. And one of the really interesting things, we've talked about this, but as consumer price index was increasing rapidly over the last 24 to 30 months, retail sales were outpacing that growth. And one of the reasons that was possible was because the personal savings rate was off the charts as people got checks for COVID stimulus and everything else. So people built up their savings account and then they spent more than inflation. But now they're finally running out of that savings. Here's a few stats. So credit card balances were up 15% on the year, ending in the third quarter, which is the largest increase in more than 2 decades. If we talk about the ports of Los Angeles and Long Beach, which we've talked about a ton, like we were 2 years ago when no one could get, the supply chains were messed up in those ports, and there were boats as far as the eye can see waiting to dock. They're down 21% in December and have been below 2019 levels since August. Like, things are just maybe crumbling here. Now, this is on the news of an incredible jobs report that came out Friday, though. So it's a schizophrenic economy, but I think the U.S. consumer is struggling more than they have been in recent times.
I mean, the reason you state that you pulled this one for me is because this is something I've been just riled up about for the last 12 to 18 months. I don't know how long at this point. And I think, so agreed, yesterday, the jobs report was
bonkers, crazy.
What, like 3 times what the estimates would be as to how many jobs were added. Yeah, way bonkers. Surprised everybody. I think, though, the thing is that we end up, by we I mean broadly, the world ends up comparing data that has different lag times.
Mm-hmm.
Right?
Yeah.
And I mean, I'm still in the same place that I've been at, where future people are hurting. They just don't know it yet. And this is starting to say that some of them already know it, right? This combined with, it's in here too a little bit, but then there's that other piece around people pulling money out of their 401ks, right? And the consumers are not in a good state. And you can look at what we can call like stock variables, meaning I don't mean equities. I mean, if you look at like static numbers, balance sheets, that kind of stuff. If you look at that, you can be like, oh, that doesn't look bad. Like, this looks pretty good. But if you look at the change, right, as you were just talking about, if you look at the rate of change in savings rates, spending rates, all that, it does not look favorable. And you zoom out into the future, I'm personally scared. I think that the number of jobs that are getting added are making people feel like jobs are still available for me. I can still do what I want. I can switch and whatnot. And I think that there's only a matter of months. I hope not. What I'm about to say is I hope not, but I believe that the corporate tide is going to continue turning. It's been churning through the quote unquote, I don't know, what do you call it? White collar workers, whatever. I don't know, tech workers.
Yeah.
And I don't know. It doesn't look favorable to me. So it gets sad for future folks. But if we can just calm down a little bit, it doesn't have to be that bad. Just calm down a little bit.
Well, you mentioned that more people are tapping their 401ks right now than average. The other really interesting piece from this article is it broke down by different income levels the share of US adults whose monthly expenses were greater than their income.
Mm-hmm.
So if you make less than 50K, 27% of that population has expenses exceeding their income right now. 50 to 100K, it's almost 15% of the population that have expenses exceeding their income. And 100K is almost 10% of folks.
Yeah.
It's craziness.
Yeah. And it compounds month over month. It's going to be rough. It's going to be rough. I know you're going to hate everything about this. And the reason you're going to hate everything about this is because it's silly to talk about stuff like this, but I am so interested in it. Bringing on historical analogies is what I'm about to do. There's a lot that when I like kind of look at, and this is purely, I'm not taking into account all variables. One, because I can't, and two, because I'm just not. But when I was thinking about last year and the hit that happened last year, and where my other, I don't know, spidey senses and indicators, whatever, say that we are, the historical analogy that it reminds me of is 1970.
Yeah, if your spidey sense, if we start making forecasts with a spidey sense, we get kicked off the podcast. I don't know. This is in the ground rules, Doogles. Like it's Skippy Talks Investing show. Now.
The Skippy, you're just gonna leave a blank though. It'll be Skippy and
Skippy and friends.
Yeah, and friends. Yeah. No, it's interesting. The reason I bring that up though is because 1970 was a rough year in the stock market. It was kind of like the tremor before the real storm. So if you go from the 1960s up until the mid 1960s up until 1970, the S&P 500 went up like 2x or so, something like that during that period. Then in 1970, you get like it goes down like 30% over the not purely in the year, but like over the course of a 12 to 18 month period, goes down like 30%. Then you pop back up until 1973, and then you have a 2-year rough go at it. So that what we know is that exactly is not going to occur. But my broader point there is that I think we might be in a period where we got hit. That's not I still do not think that we are in the full hit right now. I still do think that there's the potential that we recover back to all-time highs, and then it falls off a cliff. So that's all. Whether that takes 2 years, 3 years, 2 months, like who the heck knows? But now the S&P 500 is roughly 15% off of its all-time high. So it's like not a wild thing to consider it goes back there.
Now, this is the last thing on my list. And, I hate predictions, so I don't even want to do it. But let's just, if it's just friends talking, like I don't handle my stocks going up as quickly as they have gone up in 2023. Well, yeah, I don't like it at all. It feels so bubbly. Like
your stocks is off the cheesy.
I don't. Let's not talk about it because I don't want to jinx anything. But oh my goodness, like, and so I don't know. I'm definitely more focused on my portfolio than I am the overall market. So maybe I'm disconnected from that. I don't know if like most people feel that way, but I just am going, man, this no. Mean reversion needed to happen. We needed to come way back down and continue down for an extended period of time. And all of a sudden, we just decided to party in 2023. Like, I don't know, someone popped some champagne and here we go. It's craziness again.
Well, that's the reason why Connor McNeil wrote about that Seth Klarman investment letter, because they're like, hold on. Everything just happened over the last couple of years. We had all these bubbles, and then people were like, why are you stupid in the bubbles? Why are you day trading? All this stuff. And he goes, and now I'm just seeing it starting to happen again. And it's been a year. Like, and
it feels like a head fake. Like it just feels like, oh, this is one last puff of craziness before we actually come back down to reasonable evaluations or something. But I hate doing that because I think you even said that 6 months ago when things were trending down. You were like, I think we're going to get one more head fake before it actually comes back to fair value. And I just can't believe the kind of greed that's out there right now, or appears to be, because stocks are just going crazy.
Yeah, they are. Can I go into my last item then?
Yeah.
Okay. Big disclaimer before this last item. We're going to talk about some real stuff. some real, like an actual equity that we own. I want to talk about it because I'm talking to my friend here and I'm curious. But this by no means is a recommendation for you to do anything with this. I just think it could be an interesting discussion for y'all. So I want to talk about Meta.
Mm-hmm.
So Meta, a couple quick facts. In September 2021, Meta peaked at around 380, like last peak. In October 2022, the last bottom was around 90, and now it's trading at about 185. Okay.
Mm-hmm.
So both of us own Meta, bought into Meta, and I'm curious what your current thought process is. I don't know if you had a sell point or sell criteria already in mind. This has been like the recovery is so quick, like that. I'm not saying this is the ultimate recovery. I just mean like the price change over the last like 4 months, it's doubled, has been so quick. I'm curious what your thought process currently is.
Yeah. So if you go back in your text, remember there's like a scribble from me 2 years back when it was still, when the ticker was still FB. And I took a picture of the Morning Star screenshot. You're not going to be able to find it. I see you on your phone. And I scribbled on top FB 160. That was my, like, something like 2 years ago. That was my back of the envelope calculation on my buy points. Now, my buy point is not the valuation because I like to have a huge margin of safety, right? I've always thought, and I hate to be this specific, but guys on the pod, this is not an investing recommendation. This is not something you should do with your money. This is me and Doogles chatting. I always thought true value was definitely north of 260 and maybe closer to the 300 range. So I started building my position in the 160 range, rode it all the way down, and actually made some purchases in the 90s. And that was like, you know how it is, Doogles. Like, I was like, well, I've deployed all my cash back at 120. Like, I was like scrounging to try and find money to throw into it, which is really tough to do psychologically. But I just felt like it was not worth $90 a share.
I woke up at 3 a.m. Skippy was in my sock drawer looking for change.
That's right. I got a few pennies in there. And now the thing just exploded. I mean, and kind of for good reason. This is why I love buying cheap stuff, because the littlest positive news can just make the thing explode, because people are going, well, just a year ago, this was in the 300s. We talked last week about Bill Gurley seeming to go out of his way to be like, one stock that's odd right now is Meta. The cash flow is great and it's like cheap, like I think there's a lot of momentum around this. And so do I expect it to just go up from here? No, I expect it to fall back down and be crazy turbulent and have people freak out. And if we have a 3-year down run, I expect it to continue. Maybe it'll trend back down to $100 a share. But I think there's a lot more upside long term. I don't plan on selling it anytime soon.
Yeah, it's one of those things it's really annoying to me, these circumstances. And but they happen all the time. So I'm just annoyed a lot, but it's part of the fun for me. The stock market is, so if you recall, I was like, I have no interest in owning this stock. Like, it's like not a stock.
I don't like the stock. I don't like the CEO. It just got too cheap. I couldn't ignore it.
No interest. And I said, because when I was looking at it though, I had it. It was like one of the probably like 15 stocks that I had in like a watch list. Like, it wasn't my real watch list, but this is stuff that's in a watch list. And I think the number that I had for it at the time was like, if it starts to hit like around the 170, 180, that's interesting. But I actually don't have any interest in buying it until it's like, if it's in the 150s, it's hard to resist. That was like so then it got to the 150s, if you recall. And I was like, crap, but I really don't want to, I just don't want to own this stock. And then it was when it got down to the 130s, I was like, okay, well, like, I mean, this is just, if you're going to give away your money, then I guess, I'll take it. And then as you did, started buying it down. And with it coming back up to like the 190s, I'm just like, this is not a sell thing. I'm just kind of like, this is a point where I wouldn't have bought it. Like, it's at like a point where I wouldn't have purchased it, which is just like annoying.
I love that perspective, because it's like, you're not personally invested in this. You never really wanted to own it. It's not like a company that you can root for. And that's different when you like, sometimes see, pretty much all my stuff is like about the dollars and cents of it. It's like this auto part manufacturer in New Jersey. It's cheap. I bought it. I don't really care about the auto parts, but your typical approach is more like dive into the company. You're almost rooting for the company. You're like truly invested. And I could get to you're like, okay, well, it's not unquestionably cheap anymore. It's like maybe in the range of fair value. So I could understand kind of wanting to dump it around here.
Yeah, it's at the point where if it's like between here and $200 a share after my long-term capital gains would kick in, I might consider like unleashing it, because it's also, I don't know, something like 12 to 13% of not my overall portfolio, but of like the my individual stock pick portfolio. So if you take the quantitative out of it, so it's like a sizable chunk that I don't want to own of the stuff that I kind of pick. And so if after the year, I think I might consider it, but I'm not right now. It'll be an interesting ride.
I lied when I said that was my last thing. I got one thing. I just got to reward the listeners who made it to the end of the show with us. Doogles, you might have to cut this. This is a show for the kids, but there's one thing I got to talk about. So,
I know where you're going.
Academic research paper, man. Okay, so the male reproductive organ, I think is how I'm gonna say it. It was about that and fast cars, and these academic researchers basically lied to middle-aged males about the average size of a reproductive organ. And then they did that. It basically created a comparison between them and this average that was artificially inflated to make people think that regardless of how things are, they're on the small side, right?
Wait, what was inflated? the male reproductive organ or the
the average. So they're like, oh, the average size is significantly larger than the average, which makes them feel self-conscious and feel like they're on the small side. I don't know if I'm doing a good job talking through this. And then they ask them to judge how much they wanted to buy a sports car, basically. And do you know what they found?
Yes, I do.
They were more likely to want to buy a sports car when they're feeling a little self-conscious.
I'm going to go to brass tacks here, because to make sure that folks get this. So there was a study that took a couple groups of men, and they said, we're going to tell this group of men that the average penis size of males is lower than the actual average. And we're going to tell this other group a different number. And what they found was that when they told individuals that the average penis size was larger than the actual average penis size, that those individuals were more likely to want to buy fast luxury vehicles, assuming overcompensation. It ties a bit back to the Morgan Housel piece. Sorry, Morgan, I apologize to you, Morgan, for associating you with this, but it kind of ties back to it, right? Am I wrong?
You're right. And thank you for just like saying it. That's what I should have done instead of being around the bush.
I mean, instead, you thought it might be better to talk about inflated male reproductive organs.
Well, facts for life, kids. If you love analogies like that, rate and review the podcast, and hit us skippydoogles.com or skippydoogles@gmail.com for listener mail. Thanks for having fun with us today, guys, and we'll talk to you soon.